Hey everybody, Smart Silver Stacker here. Welcome to another live stream. We have got a lot to talk about in this video. We have just received a stark warning from the Wells Fargo CEO. We got some new jobs data today, which confirms the weakening U.S. jobs market, that strong job market that Jerome Powell and the powers that be love to cite, starting to show some serious signs of weakness. And also, we got to talk about this surprise spike in a critical overnight lending rate. And now all of this, very bad news for the US economy, very bad news for the Federal Reserve, whose narrative of a soft landing is beginning to fall apart. I mean, it's real. Investors are realizing, we're realizing now that this soft landing stuff is nothing more than a fairy tale. But of course, this will be good news for the price of gold and silver. There's a silver lining, at least, to all of this negativity, because the Federal Reserve ultimately is going to be forced to print vast sums of currency to try to prop up this collapsing economy. So we're going to get into it today. We'll talk about all these stories. If you want to get your hands on some gold and silver, some hard assets, make sure you check out today's video sponsor, sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Now, let's get right into this first story here from the Wells Fargo CEO yesterday, who warned us to expect severance packages to exceed $750 million. So they're going to be doing almost $1 billion worth of potential layoffs here, potential cost cutting by this major bank. And there's some other things he warned about here. Said, we're continuing to focus on efficiency with turnover dropping. Unfortunately, we're going to have to be more aggressive about our internal actions. And so, this job market that Jerome Powell keeps citing, the most robust job market ever, the strongest economy ever. Well, we're continuing to see some significant problems here. The bank, Wells Fargo, has reduced its workforce since the third quarter of 2020, and it stood at 227,363 at the end of the third quarter of this year. So you can see what a big employer this is. And he went on to say, we feel very good about the progress that we have made. Well, I'm glad to see that, he feels good about that, but that is not a good sign for the labor market. Also, he pointed out that there are some real problems for Wells Fargo in terms of its commercial real estate portfolio, particularly the office loans. And he said, we expect to see losses in this office portfolio in Q4, which will continue into next year. Wells Fargo has set aside $359 million for potential credit losses on office real estate in the third quarter, bringing total allowances to $2.6 billion for the first 9 months of 2023. Now, this is a real reason why the Fed is likely going to have to cut rates, because the problem here is you've got about $2 trillion worth of commercial real estate loans, which are set to mature over the next 2 years. And the real problem is that the collateral, the properties that are backing up those loans, well, they're not worth as much as they were when those loans were written, because higher interest rates have discouraged purchasers from going out and buying these deals. So what's going to happen is either these banks are going to need a bailout in the form of liquidity injections from the Federal Reserve, more emergency lending facilities. They're going to have to take a big haircut on their commercial real estate portfolios. Or what the Fed may do, what I think they're going to do, is they're going to have to cut rates to try to stimulate demand for these real estate properties and drive up the asset valuations. But when you have the CEO of one of the nation's largest banks warning about layoffs and commercial real estate, you have got a real problem here. Now, also today, we just got this data from the ADP, so a private organization here with their private payroll numbers. Now, I trust this number more than the non-farms payroll that we're going to get on Friday, which also will likely have a significant impact on markets. But this is the one I think we should be paying attention to. And according to ADP, numbers that were released today, private payrolls grew by 103,000 workers in November. That was below the downwardly revised number that we got for October. So Not only are they downwardly revising the numbers from October, but also this is well below expectations of 128,000. So we're continuing to see signs of significant weakness here in the labor market. And keep in mind that 2024, which is now right around the corner, we're in the final month of 2023. 2024 is going to be an election year. And as the employment market continues to suffer, and it likely will, we know that factory orders in the US are declining. We know that businesses across the board are suffering. We know that organizations like Wells Fargo are laying off employees. And now, actually, according to this data, the hospitality industry is beginning to show some weakness. The hospitality industry has led job creation since COVID, but now in this most recent number, hospitality records a loss of 7,000 jobs. So, this is a sign of a slowing economy. If consumers who are tapped out, they don't have enough savings, they don't have cash, the stimulus payments have all been spent now. That's why, everybody was dining out for the past 2 years. They were getting free money, the government dole. Now that's all done. That's why we're beginning to see hospitality signs decline. And this is going to continue as consumers remain tapped out. And I see Jeff there in the comments. Thanks for all the support, Jeff, and to all those members and those who give super chats. And really listen, we've got 114 people watching right now, 27 thumbs up. If you'd like to support this channel, do me a favor. It's very simple. Smash that like button. Hit that like button. That helps get this information out into the algorithm. And if you want to support the channel, that's one of the best things you can do. So I appreciate everybody who's done that. Also, check to make sure you haven't been unsubscribed from the channel. I know that's been happening to people. So hit that subscribe button if you haven't yet. And if you've been unsubscribed, resubscribe. Make sure you get notified of all these videos. I'll try to keep all of you up to date on the economic collapse that we are going through. So ADP numbers showing significant weakness. Now, the non-farm payroll is going to come out on Friday. How's that going to go? I'm not sure. Those are government numbers, so I don't trust those nearly as much. But I think this is about as good as we're going to get in terms of accurate data on the jobs market, now showing some significant signs of weakness. Now, this is an interesting story from Bloomberg, and this is something that we really should be paying attention to. This is a story about repo market spikes conjuring memories of September 2019 U.S. funding turmoil. So the SOFR has spiked, and that is a rate for overnight lending, similar to LIBOR. This is the mechanism which has replaced LIBOR, and it hit a record high on December 1st of 5.39%. Now, it has kind of come back down to normal, but this is for overnight lending. This is a facility that financial institutions use for getting liquidity. Basically, it's a collateralized short-term loans. They're backed up by U.S. Treasuries, but the rate on them hitting a record high. And if you recall, back in 2019, there was a similar problem in the overnight repo markets where rates began to spike, liquidity began to dry up. There was a liquidity crisis. And the reason that we should pay attention to this is that that event was one of the triggers for the Fed to begin cutting rates. This rate hike that we're on now, it really wasn't the first one in the past decade. Back in the end of 2015, beginning of 2016, by the way, this is a chart of the federal funds rate. The Fed actually began hiking rates, trying to normalize its balance sheet, get rates back up to normal levels, quote unquote normal, from a period where they had been held down near zero. But then in 2019, in September, we saw overnight rates spiking, and this created a liquidity crisis, which caused the Fed to begin cutting. Now, they cut a lot in 2020. We all remember why. But the crisis, the economic problems, actually started in late 2019. It wasn't all the pandemic. It was partially to do with these rate hikes creating a crisis in the overnight markets. So just this past Friday, we saw the new mechanisms, this SOFR rate spiking to record highs. And this is just another example of how the Fed hiking rates in this debt-addicted economy is really starting to begin creating problems for the whole financial system, and the cracks are beginning to show. Now, according to this article, back in 2019, Increased government borrowing exacerbated a shortage of bank reserves that was created when the Fed stopped buying as many treasuries and investors had to take up the slack. Overnight repo rates in funding markets, widely relied upon by Wall Street banks to fund day to day operations, temporarily jumped fivefold to as high as 10%. So, this move that we saw in the overnight rate was not as significant nearly as this spike that we saw in 2019. But that doesn't mean that something like that may not be around the corner, because certainly we are still continuing to see massive amounts of government borrowing. And right now, the Fed continues to sell treasuries from its balance sheet into the market. So if we see a big spike in the overnight rate, well, that's probably going to mean a immediate end to those quantitative tightening operations and an immediate return to QE. So keep an eye out for that. And also, one last look at this chart of the federal funds rate. I mean, we have now surpassed by far the level that was achieved in 2019, which created that crisis. We're actually now back up all the way to where we were before the great financial crisis. And of course, if you recall back during this time in 2006, there was a lot of talk about a soft landing, a lot of talk about avoiding negative consequences of the Fed tightening. Well, we all know how that worked out. So this chart here is going to look a lot like this in the near future, if you ask me. Markets are already beginning to price that in, but I don't think that they're pricing in just how bad things are going to get and just how much the Fed is going to have to cut and how much money they're going to have to create. And when the Fed does return to a policy of easing, when they do begin printing money again, I believe that we're going to see the price of both gold and silver moving very strongly to the upside. It's not financial advice, of course, just my take on things. But that's why I'm continuing to take advantage of below prices. I mean, gold, not that low anymore. It's just below an all-time high. Of course, it took out an all-time high on Sunday night, and I think we're going to be surpassing that high in the relatively near future. It might take some dovishness from the Fed, but that's exactly what we're going to get as the economy continues to collapse before our eyes. And silver, well, silver's back under 25 bucks right now. So silver's nowhere near its nominal all-time high. It's at something like 13 or 14% of its inflation adjusted all-time high. So silver continues to be, I believe, the most undervalued asset on the planet at the moment. Again, not financial advice, just giving you my take on things, but I'm going to keep stacking it. So let me know what you think in the comments down below about these developments. Is the Fed going to be forced to return to the printing presses soon because of this collapsing economy? I think so, but I would like to know what you have to say. So thanks for tuning in, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker out.